On January 29th, 2026, silver touched 121.67 per ounce, the highest nominal price in recorded history. One day later, on January 30th, that number sits around $95, a drop of roughly 17% in 24 hours. And the question everyone's asking isn't why it fell. The question is, who sold at $121? Who actually hit the sell button at the top while everyone else was screaming about $200 targets? And more importantly, who's buying now after a 17% collapse that felt like the floor dropped out? Because the sell at $121 story and the buy at $95 story are the same story told from opposite sides of the table. One group locked in profits that will define the next decade of their wealth. Another group is quietly positioning for what they believe comes next. And understanding which group you belong to, which group you want to belong to, matters more right now than any price chart. This is not about predicting whether silver goes back to $121 tomorrow or crashes to $70. This is about understanding market structure. This is about reading the players, not the price. Because when a metal rises 250% in 12 months, hits an all-time high, and then drops 17% in a single session, that volatility isn't random. It's mechanical. It's the sound of one type of capital exiting and another type entering. And if you can identify who's on which side, you can position yourself accordingly without getting caught in the emotional whipsaw that destroys most participants. Let's start with the sellers at $121. Who actually had the metal to sell? Who had the stomach to sell it? And why did they choose that exact moment? The first category of seller is the most obvious and the most mechanical. Momentum traders. These are not long-term holders. These are not people who bought silver in 2020 at $18 and held through every dip. These are the participants who entered the trade in November 2025 when silver was around $65. And the narrative was just starting to heat up. They rode the wave from $65 to $80, from $80 to $100, and from $100 to $121. And somewhere around $115 to $121, their algorithms, their risk managers, or their own profit targets told them to exit. Reports confirm that on January 26th, the iShares Silver Trust, ticker SLV, saw a turnover of nearly $40 billion. To put that in perspective, that's similar to the daily volume of SPY, the S&P 500 ETF. Silver, a relatively small market, was trading hands at a velocity comparable to the largest equity index in the world. That's not institutional accumulation, that's speculation. That is hot money rotating in and out at speeds that have nothing to do with the fundamentals of industrial demand or monetary debasement. When you see volume like that, you're watching leverage unwind. You're watching traders who bought silver futures on margin at $100, watched it run to $121, and then faced a choice. Do they hold and risk a margin call if it reverses? Or do they sell into strength and lock in a 20% gain in 3 weeks? The math is simple. A 20% gain in 3 weeks annualizes to over 300%. No trader in history has ever gone broke taking a 300% annualized return. So they sold. Not because they think silver is done, but because they're traders, not investors. Their job is to capture moves, not to marry positions. The second category of seller at $121 is more interesting because they're quieter. Institutional rebalancers. These are pension funds, endowments, and family offices that allocated to silver somewhere between $50 and $80. They did not buy silver because they wanted to speculate. They bought it because their asset allocation models told them to diversify into hard assets as a hedge against currency risk and geopolitical instability. But those same models have rules. When an asset goes from 5% of a portfolio to 12% of a portfolio in 6 weeks, rebalancing is mandatory, not optional, mandatory. So at $121, these institutions weren't selling because they thought silver was overvalued. They were selling because their internal compliance departments, their investment committees, demanded that they bring exposure back down to target levels. This is price-insensitive selling. It doesn't matter if silver is going to $150 or $80. The rule says sell, so they sell. And when a pension fund with $10 billion in assets decides to trim 2% of its silver allocation, that's $200 million hitting the market. Multiply that across dozens of institutions, and you have billions in selling pressure that has nothing to do with market sentiment. The third category, and this is the one that gets the most attention, but is probably the smallest in actual volume, is the retail profit taker. This is the individual who bought physical silver coins at $30 in early 2025. Maybe they bought 100 ounces. The premiums on physical silver tell this story clearly. In December 2025, premiums on American Silver Eagles were running at $8 to $12 over spot. By mid-January, as spot price climbed above $110, premiums actually stayed elevated or in some cases increased, indicating that retail wasn't flooding dealers with metal to sell. But by January 29th, as price touched $121 and then began to crack. Anecdotal reports from dealers suggest an uptick in sellers. Not a flood, but an uptick. The kind of uptick that happens when people realize that $121 feels like a top, even if they don't have data to support it. Now, here's the critical distinction. Retail physical holders who sold at $121 actually received less than $121. By the time you account for dealer spreads, you're probably selling at $115 to $108, depending on the form and the dealer. So the headline number of $121 is somewhat misleading for physical market participants. The paper market touched $120. The physical market never really traded at that clean number in meaningful size. But the largest and most strategic seller at $121, the one that almost nobody is talking about because it's not public, is likely the producers, silver mining companies and refiners. These entities have been sitting on record-breaking profit margins for months. When silver was at $30, a primary silver miner with all-in sustaining costs of $18 was making $12 per ounce in margin. At $121, that same miner is making $103 per ounce. That's an 800% increase in margin. And for miners, high prices create a strategic opportunity. They can forward sell a portion of future production, locking in prices that guarantee profitability for years, even if prices collapse. Reports indicate that throughout 2025, as silver climbed, many producers were cautious about hedging because they didn't want to cap their upside. But at $121, the calculus changes. Even the most bullish mining executive looks at $121 and thinks, if I can lock in $110 or $115 for a portion of next year's production, I'm securing the company's future. So they sell forward. They enter into delivery contracts with industrial buyers or financial institutions, effectively taking supply off the spot market at elevated prices. This doesn't show up as a sell order on the COMEX. It shows up as reduced available supply in the future, which is why the market doesn't always see it in real time. The producer hedges rational, strategic, and invisible until months later when you look at their quarterly filings and see that they locked in prices at levels that seemed insane at the time, but turned out to be intelligent if the market corrects. So you have momentum traders taking profit, institutions rebalancing, retail cashing out modest amounts, and producers hedging future output. All of these sellers converging at the same psychological level, $121. Not because they coordinated, but because round numbers and all-time highs create natural resistance. Markets are made up of humans and algorithms, and both are programmed to pay attention to milestones. $121 was a milestone. It was the highest price ever recorded, and milestones are where profit-taking accelerates. But selling at $121 doesn't mean those participants think silver is finished. It means they think $121 is high enough to justify reducing risk. And that's the distinction that matters. Selling isn't always bearish. Sometimes selling is just risk management. Now let's flip the script. Who's buying at $95 after a 17% drop? The first and most obvious buyer at $95 is the same momentum trader who sold at $121, but in reverse. After a violent sell-off, technical traders look at the chart and see a pullback from an extended move. Silver rallied from $30 to $121. That's a move of $91 or 303%. A 17% pullback after a 303% rally is not a collapse. It's a retracement. And technical analysts love retracements because they're seen as healthy. They shake out weak hands, reset sentiment, and create a new base for the next leg up. So the trader who sold at $121 isn't necessarily bearish on silver long term. They're just waiting for a better entry. And $95 after a $26 drop looks like that entry to many. They sold high, they're buying lower, and they're planning to ride the next wave if it materializes. This is the essence of trading. It's not about being right on direction. It's about capturing volatility in both directions. The second buyer at $95, and this is where it gets more interesting from a structural perspective, is the industrial user. Companies that consume silver for manufacturing did not stop needing silver just because the price hit $121. In fact, for many of them, $121 was terrifying because their input costs were exploding. But at $95, after a sharp drop, procurement teams see an opportunity. If they were holding off on purchasing because $121 felt unsustainable, $95 gives them a window to lock in inventory at a more manageable level. Reports indicate that throughout 2025, industrial users, particularly in solar panel manufacturing and electronics, were moving from just-in-time inventory management to just-in-case hoarding, meaning they were buying more silver than they immediately needed because they feared supply disruptions and continued price appreciation. At $95, that hoarding impulse doesn't disappear. If anything, it intensifies. because the drop from $121 to $95 could be seen as a temporary discount before the next leg up. So industrial buyers step in, not because they're speculating, but because they need the metal, and $95 is better than $121. The third buyer, and this is the one that defines whether $95 is a floor or just a bounce, is the strategic accumulator. These are sovereign wealth funds, central banks in emerging markets, and high net worth individuals who view silver not as a trade, but as a long-term hedge. Reports confirm that throughout 2025 and into early 2026, central banks and institutions have been accumulating physical precious metals as part of a broader de-dollarization strategy. They're not buying because they think silver is going to $150 next month. They're buying because they believe the dollar-dominated financial system is fragile, and hard assets with no counterparty risk are worth holding regardless of short-term price. Data from late 2025 indicates that central banks, particularly in countries like Russia, India, Turkey, and Saudi Arabia, have been adding silver to strategic reserves, treating it not just as an industrial input, but as a monetary asset. When silver drops from $121 to $95, these buyers don't panic. They don't sell. They view the drop as an opportunity to acquire more at a discount. These are price-insensitive buyers over the long term, but they're also patient. They don't chase. They wait for volatility, and then they step in. The fourth buyer at $95, and this one is more speculative but worth noting, is the contrarian retail investor. This is the person who watched silver go from $30 to $121 and thought, I missed it. They didn't buy at $50 because they were scared it was overvalued. They didn't buy at $80 because they thought it would pull back. And they definitely didn't buy at $121 because that felt like the top. But at $95, after a 17% drop, the psychology shifts. Suddenly it feels like a second chance. It feels like the market gave them a gift, so they buy. Now, this type of buying can be dangerous because it's driven by emotion rather than analysis. But it's also real. Retail participation surged in late 2025 as silver broke through $50 and $60. And after a correction, retail often re-enters because the fear of missing out is stronger than the fear of losing money. That's not a judgment. That's just how human psychology works in bull markets. The fifth and perhaps most important buyer at $95 is the short covering. Throughout the rally from $30 to $121, there were participants betting against silver. Hedge funds, institutional traders, and even some mining companies with short hedges in place. When silver hit $121, these shorts were underwater, badly underwater. A short position entered at $80 is now showing a $41 per ounce loss. But when price drops from $121 to $95, that loss shrinks to $15 per ounce. And for many shorts, that drop creates an opportunity to cover, to buy back their position and exit before it rallies again. Short covering is mechanical buying. It's not bullish or bearish on the asset. It's just participants closing out losing positions. But mechanically, short covering creates buying pressure, which can support the price or even drive it higher. So at $95, you have a mix of fresh buyers who see value and forced buyers who are exiting shorts. Both create demand. Now, let's address the elephant in the room, the question that everyone watching this wants answered. Is $95 the bottom, or is this just a pause before a deeper drop? The honest answer, and this is important to state clearly, is that nobody knows. Not the banks, not the analysts, not the most sophisticated algorithmic trading system in the world. Markets are probabilistic, not deterministic. But we can look at the structural factors that suggest whether 95 is likely to hold or likely to break. On the bearish side, the case for further downside is straightforward. Silver rallied 250% in 12 months. That's a parabolic move by any historical standard. Parabolic moves tend to retrace deeply because they overshoot fundamentals. If silver was fairly valued at $50 based on supply-demand dynamics, then $121 was a speculative overshoot, and $95 might still be overvalued. A retracement to $70 or even $60 would not be shocking in the context of a 250% rally. It would just be the market normalizing. Additionally, former JP Morgan strategist Marko Kolanovic, a name that carries weight in institutional circles, recently warned that silver's movie looks similar to historic bubbles. His commentary suggests that the rally has become detached from fundamentals and driven primarily by momentum and speculation. If that's correct, and if momentum reverses, the unwind could be severe. There's also the simple fact that lease rates, which spiked to around 8% in January, indicate a market under stress. But stress can resolve in two ways. Either the price rises to attract supply, or the price falls to destroy demand. A drop from $121 to $95 is the market attempting the second resolution. If demand continues to weaken, price can fall further. On the bullish side, the case for $95 holding is equally structured. First, the supply deficit is real. The Silver Institute confirms that silver has been in a structural deficit for 7 consecutive years. More silver is being consumed than mined. That deficit has been filled by above-ground stockpiles and recycling, but those sources are finite. At some point, if demand remains elevated, price must rise to either incentivize more production or destroy marginal demand. Second, China's export restrictions, which went into effect on January 1st, 2026, have fundamentally altered global supply chains. China controls 60% to 70% of refined silver exports. By restricting those exports to only large, state-approved companies with special licenses, China has effectively weaponized silver supply. This isn't a temporary policy. This is a strategic move to secure domestic supply for China's own industrial needs, particularly in solar, EVs, and high-tech manufacturing. As long as those restrictions remain in place, the global market outside of China is structurally tighter. Third, central bank and institutional buying, while not as visible as retail or speculative flows, provides a floor. These buyers don't sell on a 17% drop, they wait. And if price stabilizes or shows signs of resuming the uptrend, they add to positions. This creates what traders call a bid under the market. It's not infinite, but it's real. Fourth, industrial demand isn't going away. The build-out of AI data centers, the expansion of renewable energy infrastructure, the ongoing production of electric vehicles, all of these require silver. And unlike speculative demand, which can evaporate overnight, industrial demand is sticky. A solar panel manufacturer can't just stop buying silver because the price dropped from $121 to $95. They need the metal. So industrial buying continues regardless of sentiment. Finally, and this is more psychological but still relevant, $100 is now a psychological support level. Silver has spent several weeks trading above $100. The market has internalized $100 as a new normal. Breaking back below $100 creates discomfort, but holding above $90 or $95 suggests that the market views triple-digit silver as sustainable, at least for now. So where does that leave us today, January 30th, 2026? It leaves us in a market that is consolidating after an extreme move. The sellers at $121 were rational. They took profit after a historic rally. The buyers at $95 are rational. They see a pullback in a structural bull market. Neither side is stupid. Neither side is guaranteed to be right. What matters now is not predicting the next move. What matters is understanding your position relative to the market structure. If you sold at $121, you executed a disciplined trade. You captured a massive move, and you reduced risk at a logical level. Whether silver goes to $150 or $70 from here, you locked in a win. That's intelligent capital management. If you're buying at $95, you're betting that the structural forces driving silver, supply deficit, geopolitical fragmentation, industrial demand are stronger than the speculative excess that drove it to $120. You're betting that $95 is closer to fair value than $121 was, and that the next major move is up, not down. That's a reasonable bet, but it's still a bet. And it requires the ability to hold through further volatility if it materializes. If you're doing neither, if you're sitting in cash or sitting on a position you bought at $60 or $80, then your job is to manage your existing exposure and avoid emotional decision making. The worst thing you can do in a consolidation phase is panic sell after a 17% drop or FOMO buy after a bounce. Both are driven by emotion, not analysis. The participants who sold at $121 and the participants buying at $95 share one thing in common. They have a plan. They have rules. They're not reacting to price. They're executing strategy. And in volatile markets, strategy beats emotion every single time. So the question isn't who's right. The question is, do you have a plan? Do you know what price level would make you a buyer? Do you know what price level would make you a seller? Do you know what percentage of your portfolio you're willing to allocate to a volatile asset like silver? If you can answer those questions, you're prepared. If you can't, you're gambling. One final observation. The sell-off from $121 to $95 was violent, but it wasn't a collapse. Trading volumes remained elevated, which means liquidity didn't disappear. The bid didn't vanish. The market found buyers at $110, at $105, at $100, and at $95. That's a functioning market. It's volatile, yes, but it's not broken. Contrast that with a true collapse, like what happened to silver in 1980 after the Hunt brothers were forced out. In that case, silver dropped from $50 to $10 in less than 2 years and stayed depressed for over 3 decades. That was a collapse. This is a correction. And corrections in bull markets are normal, healthy, and often where the best long-term entry points are found. The story of who sold at $121 and who's buying at $95 is ultimately the story of market cycles. Every major move has 3 phases: accumulation, when smart money quietly builds positions; Markup, when the trend becomes obvious and everyone piles in. And distribution, when smart money quietly exits and the crowd is left holding the bag. The question you need to answer for yourself is, where are we in that cycle? Did distribution happen at $121, meaning the top is in and the next major move is down? Or was $121 just a short-term overshoot in a longer-term markup phase, meaning the trend resumes after consolidation? Nobody can answer that with certainty today. But by watching who's selling and who's buying, by understanding the types of capital moving in and out of the market, you can make a more informed decision about where you want to position yourself. The sellers at $121 captured one of the greatest moves in commodity history. The buyers at $95 are positioning for what they believe comes next. Both are playing the game intelligently. The only mistake is playing without a plan. Silver hit $121. It's now at $95. The players made their moves. The question is, what's yours? Don't forget to like the video, comment your thoughts down there, and subscribe.